Hi everyone, I'm Debbie Roberts, owner and financial advisor at Property Apprentice. Join us today for the Week in Review, where I talk about current events for the everyday investor and home buyer. Our topics for this week: topic number one from interest.co.nz on the 3rd of September. New Zealanders are falling short on retirement savings. Is it time to boost KiwiSaver contributions? Topic number two from RNZ on the 3rd of September. How many borrowers have fixed regret? Topic number three from interest.co.nz on the 4th of September. Opinions split about whether it's a good time to buy a house, ASB survey shows. Topic number four from Oneroof on the 4th of September. Tony Alexander, how long have buyers got before they lose the upper hand? Topic number five from RNZ on the 4th of September. Kainga Ora takes action over tenant rent arrears. So first up this week from interest.co.nz on the 3rd of September, New Zealanders are falling short on retirement savings. Is it time to boost KiwiSaver contributions? New Zealanders are not saving enough for retirement, raising concerns about a future financial crisis. This issue was discussed by representatives from Fisher Funds, the Retirement Commission, PI Funds, and Milford Asset Management at the Financial Services Council's conference. The discussion focused on increasing employer contributions to KiwiSaver and encouraging both employees and employers to contribute more than the current 3% minimum rate. The panel agreed that 3% contributions from employees and employers are insufficient for a secure retirement. Tom Hartman from the Retirement Commission highlighted that the default 3% rate sends the message that it's enough, which is misleading for many, particularly higher income earners who should be saving more. Since KiwiSaver's inception in 2007, employers have been required to contribute 3% to their employees' gross income, while employees can choose to contribute between 3% and 10%. Murray Harris from Milford Asset Management noted that 90% of employers stick to the 3% contribution, with most employees matching it. He suggested that to encourage higher contributions, incentives like gradual increases in employer rates and tax concessions should be introduced. Anna Maria Lockyer from PI Funds mentioned that after consulting with employers, she found they were open to discussions about increasing contributions. She believes the conversation would be more receptive now than when KiwiSaver first launched. Simon Power from Fisher Funds argued that despite the current cost of living crisis, now is the right time to encourage people to consider increasing their contributions as the economic cycle shifts. KiwiSaver, introduced in 2007, aims to promote retirement savings. By June 2024, total KiwiSaver funds had reached $110.8 billion. More retirees are keeping their money in KiwiSaver beyond the age of 65 to continue growing their investments. Data from Inland Revenue showed that between January and July 2024, over $1 billion was withdrawn early from KiwiSaver, mostly for first home purchases and financial hardship. The Financial Markets Authority, the FMA, reported that net contributions to KiwiSaver dropped 15% from July 2022 to June 2023, driven by a sharp decline in lump sum payments. As New Zealand's population ages, the number of people over the age of 65 is expected to reach 1 million by 2028 and could make up 1/4 of the population by the 2050s. This demographic shift highlights the increasing importance of adequate retirement savings. And when we look at the stats that show that, at the moment, the average KiwiSaver fund by the time people reach the age of 65 is $50,000. That's well short of the amount that's recommended to provide you with choices in retirement. So my thoughts on this are, if you are in the right sort of KiwiSaver fund for your situation and you're contributing enough to get you to a point that you've got choices for retirement, I don't think that you necessarily need to increase your KiwiSaver contributions unless you particularly want to, because they are locked up until the age of 65, with the exception of that first home withdrawal, financial hardship, and a few other things like that. So if you've never had advice from a financial advisor around your KiwiSaver, maybe now's a good time to think about getting that. It is one of the things that I do for our clients at Property Apprentice is I review their KiwiSaver because I've got that investment qualification as well. So, get some help around this because what I find is that the majority of people are not only in an inappropriate fund or not contributing enough, some people are contributing more than enough, but they're just in the wrong type of fund. So, it's a combination of getting in the right fund, right risk profile for you, and contributing enough to give you choices for retirement. And the sooner you start, the easier it is, right? Second topic for this week in review from RNZ on the 3rd of September. How many borrowers have fixed regret? There are signs that home loan borrowers in New Zealand have responded to the Reserve Bank warnings in May about potential interest rate hikes by opting for longer fixed term mortgages. In May, the Reserve Bank Monetary Policy Committee discussed a possible increase in the official cash rate, the OCR, predicting another hike by the end of the year. However, in August, the OCR was cut by 25 basis points, with further reductions likely. Data from the Reserve Bank shows that the share of new loans fixed for 6 months decreased from 18% in May to 16% in June, while loans fixed for 1 year rose from 37% to 38%. Borrowers who fixed their rates for a year saw retail rates drop from around 7% in May to as low as 6.45% by August. Gareth Kennan, chief forecaster at Infometrics, believes that many borrowers have become cautious after previous experiences of mortgage rate fluctuations. Despite the market's optimism, the Reserve Bank has continued to maintain a tighter monetary policy to curb inflation. Deputy Reserve Bank Governor Christian Hawkesby acknowledged that too much emphasis was placed on OCR predictions, which are based on assumptions. He stressed that the meeting records that should take precedence over OCR forecasts. However, Kennan argued that the bank's inconsistent messaging may have led to confusion. Eric Crampton, chief economist at the New Zealand Initiative, noted that the August monetary policy statement, the MPS, showed increased confidence that inflation expectations had stabilised around the 2% target, which could accelerate rate cuts. However, he warned that the August forecasts might already be outdated due to the recent energy price shock affecting economic output. Mortgage advisor Jeremy Andrews advised clients to delay fixing rates as banks continue to lower rates. He suggested working with an advisor to navigate rate fluctuations and develop a tailored refinancing strategy. And I think that's really good advice. It's certainly one of the things that I do for our clients at Property Apprentice as well, and any of our mortgage clients at Rocket Home Loans, is that we look at their individual situation and give them advice and direction based on that and help you come up with the best decision for your situation and what your needs are. If you'd like to learn more about investing in property, join me at one of our free events called How to Succeed with Property Investing. I'll discuss strategies for successful investing from my perspective as a financial advisor, and these events are available either live online or in person in our office in Ellerslie, Auckland. Check out propertyapprentice.co.nz for upcoming dates and register today. We don't sell property, so it's all about increasing your knowledge to reduce your risk. If you've already been to one of our free events and you'd like to find out more about how we can help you to reach your financial goals, you can also book a no obligation phone call or meeting with my husband, Paul Roberts, via the website. Third topic for this week in review from interest.co.nz on the 4th of September. Opinions split about whether it's a good time to buy a house, ASB survey shows. ASB's latest housing confidence survey reveals a notable shift in public sentiment. While expectations for falling interest rates have surged, anticipation for rising house prices has sharply decreased. The survey shows a net 20% of respondents now expect interest rates to continue falling, which is a significant increase from the net 1% in the previous quarter. This growing expectation is consistent with the anticipated decline in interest rates. Historically, such a high proportion of respondents anticipating rate cuts was last seen in the third quarter of 2020, during discussions about potential negative interest rates, which didn't happen. Conversely, only a net 13% of respondents expect house prices to rise, a dramatic decline from the net 40% who anticipated price increases in the previous quarter. Isn't it amazing the difference that 3 months can make? This pessimism is reflected across all regions, though South Islanders remain slightly more optimistic about future price increases compared to their North Island counterparts. ASB's economists noted that this drop in expectations aligns with recent data showing a 3 month decline in house prices, suggesting that people's views may be influenced by recent trends. I would suggest that people's views are possibly more influenced by their own individual financial positions. And, with the current economic climate, it has been very tough for a lot of people to move forward with their plans, especially around buying property. Regarding the current market, only a net 8% of respondents believe it's a good time to buy a home, which is a slight increase from the net 2% last quarter. This contrasts with the majority, 47%, who think it's neither a good nor a bad time to buy, down from 55% previously. I would suggest that if you want to get the same results as the majority, do what the majority do. If you want to get better results than what the majority of New Zealanders get, you've got to be what we call counter-cyclical with your investment decisions. And in my opinion, this is a buyer's market, and the clue is in the word. Okay? It's a buyer's market. Not a great time to be selling, but a great time to be buying if you can get lending. ASB's economists observed that the housing market lost momentum throughout 2024. Factors such as abundant stock, which favours buyers, high interest rates, which make it tough, and slower net migration are contributing to this trend. Real Estate Institute of New Zealand data indicates an 8.6% decrease in house sales and a decline in house prices for the 3 months leading to July. ASB anticipates that sentiment may shift further towards a belief that it's a good time to buy, as house prices are expected to remain stable, listings continue to be plentiful, and interest rates are likely to fall further. So my advice to you would be to learn as much as you can by coming to one of our free events. It's a good place to start, especially since we're not going to try and sell you a property. So, just learn more about it. But this is a great time to be buying property because from here, over the long term, it's likely that house prices are going to increase. Topic number 4, Oneroof on the 4th of September. Tony Alexander, how long have buyers got before they lose the upper hand? Independent economist Tony Alexander has gathered the results from his latest nationwide survey of real estate agents, revealing that the upward momentum in New Zealand's residential property market, which began prior to the August 14 easing of monetary policy, has continued to strengthen. 2 months ago, a net 35% of agents reported fewer people attending open homes. Now, a net 42% indicate they're seeing more attendees, compared to 11% in late July. This suggests that more people are actively viewing properties, but are they buying? Although August sales data from the REINZ is not yet available, Alexander's survey indicates that a net 12% of agents are seeing increased attendance at auctions. This marks a shift from the net 11% reporting fewer buyers last month and the 37% decline seen 2 months ago. Is this increased interest leading to rising prices? Not yet. A net 7% of agents still report falling prices in their regions, though this is an improvement from the net 29% decline last month and the substantial 50% drop 2 months ago. Why then are prices not rising? One reason could be an increase in supply. A net 50% of agents report receiving more property appraisal requests, a significant rise from just 3% 2 months ago, and the highest figure since February's net 61%. So my thoughts on that is that, increased interest in the property market normally would lead to price increases. Having increased supply, I find it hard to believe that that is causing the stability in the pricing, because normally increased supply and increased demand would balance each other out. If we had less demand and increased supply, that's when we normally see a decrease in property values. At the moment, you've still got plenty of choice. less competition from other buyers. You've got some potential to buy property below its current market value. So, even if prices do drop a little bit from here, you only lose money if you sell it for less than you paid for it. But with discussions of falling interest rates contributing to market activity, more sellers are starting to enter the market. Investors are also becoming more active, and this is certainly something that we're seeing with our clients and with new clients coming through as well. There seems to be a bit more urgency in the property market at the moment than we've seen for quite some time. A net 25% of agents report seeing more investors looking to buy, reversing the net 24% decline in investor activity 2 months ago. Something that we're certainly noticing is that there's less people interested in buying new builds at the moment. I think they've seen some of the carnage that happened for people buying new builds at the peak of the market and then saw values dropping and finding that they were unable to settle those purchases, and rental returns were pretty ugly for a number of those deals as well. So, again, make sure you learn before you jump 2 feet into the property market. Some investors are choosing to exit the market. As I said, 20% of agents report seeing more investors wanting to sell, likely due to rising costs associated with managing rental properties, such as council rates and insurance premiums, and also certainly a large number of investors that purchase new builds that no longer can afford to hold on to those, especially since interest rates might have increased from when they first signed on the dotted line to purchase those. Despite the increase in buyer activity, 48% of agents still report that buyers are concerned about job security, up from just 14% at the beginning of the year. Additionally, over half of agents indicate that buyers are finding it difficult to secure financing. On a positive note, only 24% now express concerns about falling prices, down from 44% 2 months ago. This suggests that as the market gains momentum, buyers anticipate a corresponding price rise. Currently, only 15% of agents report a fear of missing out, or FOMO, among buyers, a significant increase from just 1% 2 months ago. Nonetheless, a net 29% of agents still view the market as a buyer's market, meaning that buyers generally hold more bargaining power than sellers. Alexander predicts this situation will change, and unlike late last year when the seller's market was brief, he expects this shift to be sustained for the next 2 to 3 years. My thoughts on this are we're certainly seeing an increase in market activity in Auckland, and that will filter down throughout the rest of the country as well. Urgency certainly seems to be making a bit of a comeback at the moment. So, it's when more buyers come in and supply starts to reduce again, when things balance out a bit more, that's when we're going to start seeing price increases. So I'm certainly not expecting it to happen in the next 6 months. But 12 months from now, 2 years from now, who knows? Don't have that crystal ball that works, but sooner rather than later, I would certainly expect the housing market to start increasing in value again. Topic number 5 from RNZ on the 4th of September, Kainga Ora takes action over tenant rent arrears. Dozens of Kainga Ora tenants have recently been taken to the Tenancy Tribunal for accumulating rent arrears, a growing issue tied to housing-related debt, according to advocates. Despite these challenges, Kainga Ora is working to address the situation. In Wellington, one tenant was ordered to pay, wait for it, $34,440 $34,440 in arrears, with an additional $60 on top of her weekly rent. I mean, for crying out loud. So she's got to start paying the weekly rent plus an extra $60 on top of that to catch up on that arrears. How long is that going to take? This is taxpayer money, for crying out loud. Anyway, don't get me started. Another case in Auckland involved tenants owing $18,021 to be repaid with a $50 weekly payment. In some instances, tenancies were terminated, and rightfully so. I think there's not enough of these properties available, and there's certainly tenants who, in my opinion, would be more deserving than someone who's just not paying their rent just because. Tenants were required to pay their arrears immediately. Kainga Ora's general manager, Nick Mailing, explained that many of their tenants live on very low incomes, leaving them vulnerable to debt due to unexpected life events. He stated that the organisation engages early with tenants in arrears to create repayment plans, with around 75% of tenants making efforts to reduce their debt, like most people in New Zealand. However, when tenants fail to engage or continue to default on payments, Kainga Ora takes legal action, resulting in 15 tenancy terminations last year. Mailing emphasised that reducing rent debt is a priority, and the agency is reviewing its rent debt policies to prevent future issues. Jake Lilly, spokesperson for FinCap, highlighted that Kainga Ora debts are increasingly common. In 2023, the median debt increased from $340.50 to $1,416 compared to 2022. He noted that some of these debts arose from issues such as paperwork errors that left tenants paying higher rates than necessary. Lilly praised officials for resolving these problems when financial mentors brought them to attention and called for more proactive actions across all government departments. Vanessa Cole, spokesperson for Action Station, attributed rising arrears to the country's cost of living crisis, which has hit lower income families hard. She pointed out that despite income-related rents being capped at 25% of a tenant's income, the increasing cost of food and power have forced families to make difficult choices between essential needs and rent. Cole criticised the government's removal of the Sustaining Tenancies framework, which had been designed to prevent homelessness, saying that the approach has become more punitive rather than addressing the root cause of arrears, such as insufficient income and rising living costs. I would suggest someone who's got $34,000 worth of rent arrears is not just because of inadequate budgeting skills or because of the cost of living. I would suspect that's more like they can't be bothered. And it's those people that I think should be targeted to provide the housing for people that would at least be prepared to make an effort to keep up with their rent, which is capped at 25% of their income. I think it's a great idea to help people as much as possible, especially the low income families, which have been hit particularly hard with this cost of living crisis. And, it is pretty hard to tighten your belt when there's not much left at the end of the day. But, certainly there could be something more that could be done to help these people rather than hoping for the best. I think plans need to be made to help people before they get into a really tough financial position. With market conditions right for investing, now's the perfect time to gain expert insights, proven strategies, and exclusive tips that can propel your property investment journey forward. Register now for our free How to Succeed with Property Investing event. Visit propertyapprentice.co.nz to secure your spot. During our live online and in-person sessions, I'll tell you more about how we help our clients to achieve their financial goals. So if you're interested in finding out more about what we do, visit propertyapprentice.co.nz today and register for our free events. They are free. Welcome to anyone who would like to attend. We work with a wide range of different clients from different financial positions. You do not have to be wealthy to invest in property. You certainly don't have to be wealthy to make significant improvements in your financial position. If you've already been to one of our free events and would like to know more about how we can help you on your journey, book a no obligation phone call or meeting with my husband, Paul Roberts, through our website. That's propertyapprentice.co.nz. Thanks for listening.